Welcome to the deep dive. So today we're diving into something huge, right?
Yeah, absolutely. What really makes cryptocurrency prices tick? It's the question everyone asks.
Exactly. And we've gone through a lot of serious research, actually 88 academic articles bundled in a systematic review from last year.
Wow, 88. That's quite a stack.
It is. And we've tried to boil it down, give you a clear picture of what shapes this, well, let's be honest, often confusing market.
Definitely. And just to set the scene quickly, cryptos are basically digital payment methods operating outside the normal banking system.
Lower fees, peer-to-peer, that kind of thing.
Right. And a big part of the appeal is decentralization, user privacy, sometimes anonymity.
And behind a lot of this is blockchain technology, that shared digital ledger.
Bitcoin really showed its power making data immutable, building trust, transparency. But blockchain's bigger than just crypto now. It's touching lots of finance areas.
For sure. No, we can't talk crypto without mentioning the volatility. It's a wild ride sometimes.
Oh, yeah. Price bubbles are a real phenomenon we've seen. And unlike, say, dollars backed by a government or stocks linked to company assets, crypto value often comes down to algorithms, code.
Which makes prices react, well, fast.
Yeah.
And sometimes weirdly.
Exactly. So that review of 88 studies, it highlighted 6 main buckets of factors that seem to influence prices again and again.
Okay, let's break those down. What are they?
We've got supply and demand, the basics, then the technology itself, economic factors, the bigger picture, market volatility, those price swings, investors, what people are actually doing and thinking, and finally, social media buzz.
Got it. 6 key areas. Let's maybe start with the most fundamental one, supply and demand.
Makes sense. Basic economics 101. It absolutely applies here.
Right. With Bitcoin, everyone knows about the 21 million coin limit, right? That fixed supply.
Exactly. That cap is hard-coded. So generally, as the rate of new supply slows down, especially after halvings, which we'll get to, the price tends to feel upward pressure.
But it's not always that simple, is it? I remember seeing something about newer cryptos maybe behaving differently.
That's right. Some research suggests that for brand new coins, maybe the initial hype or other factors mean that relationship isn't quite as clear-cut. But for established ones like Bitcoin, limited supply is definitely a factor.
Interesting. And the research suggests demand actually plays a bigger role.
Yeah, consistently. What people want to do with crypto seems to have a stronger influence than just how much of it exists.
That kind of tracks.
Yeah.
When you see more people actually using Bitcoin, say trading it against the dollar or using it for payments.
Especially, in countries maybe without easy banking access, that increased utility, that transactional need drives demand and price.
Okay. And what about network effects, like the more people who have wallets?
That's huge, yeah. More wallet users, more payment accounts, more transactions happening on the network. It makes the whole system more valuable to everyone involved. That boosts demand. Can also fuel volatility, mind you.
Right. And trading volume, just the sheer amount being bought and sold.
Oh, absolutely critical. High trading volume shapes the market, impacts returns, how different cryptos move together. It's the lifeblood, really.
And you mentioned that new cryptocurrencies popping up can actually be good for Bitcoin's returns.
Seems counterintuitive, maybe, but yeah, some studies found a positive effect. Perhaps it brings more attention to the whole space.
And even with its algorithmic supply, Bitcoin's behavior still kind of fits standard economic theories.
Broadly speaking, yes. Things like its supply, how much it's used, the price level, they tend to align with concepts like the quantity theory of money, surprisingly well sometimes.
Okay, let's pivot to technology. Mining comes up first for Bitcoin. How does that work into the price?
So mining is how Bitcoin transactions get verified and added to the blockchain. It's also the mechanism for releasing new Bitcoins. So direct link to supply and therefore price.
It has the hash rate. That's the network's computing power.
Exactly. Some studies find a positive link between a higher hash rate and Bitcoin returns. The thinking is more power means a more secure network, which is attractive.
But wasn't there a debate about that? Like some argue it doesn't matter for predicting returns because the supply is predetermined anyway.
That's the counter argument, yeah. Since we know how many Bitcoins will be created and roughly when, some researchers say hash rate is irrelevant for future price prediction based on supply changes. Shows the complexity here.
Definitely. What about mining difficulty?
That's an important mechanism. It adjusts automatically to keep new blocks coming out roughly every 10 minutes, regardless of how much hash rate joins or leaves when difficulty goes up.
It gets harder to mine.
Right. And that often leads to a short-term bump in Bitcoin's price, maybe reflecting the increased cost or effort needed.
And halving, that sounds major.
It really is. It's built into Bitcoin's code. About every 4 years, the reward miners get for adding a block is cut in half.
So less new Bitcoin enters circulation after each halving.
Exactly. And historically, these halving events have been strongly associated with positive price movements and growth in market cap. It's a significant supply shock.
What about the cost of mining, like electricity costs? We hear so much about the energy debate.
That's a really debated point in the research. Some studies find a link suggesting higher mining costs, particularly energy, push up the price, almost like a production cost floor. Think gold mining costs.
Okay.
But other studies find no significant relationship at all. It's not settled. What is getting more attention lately is transaction costs, the fees users pay. That might be an increasingly important driver.
And the underlying blockchain tech itself, beyond Bitcoin.
Its impact varies. For Bitcoin, maybe less of a direct price driver according to some studies, but for something like Ethereum, with its smart contracts and ecosystem, specific tech features, unique collaborators, proposals for upgrades, the consensus protocol, those things can be really significant for its value.
So tech matters, but maybe less in the immediate short term compared to, say, economic news.
Potentially, yeah. Some findings suggest tech factors might be less sensitive day-to-day compared to big economic shifts.
Okay, let's talk about those economic factors then. How does the traditional financial world bleed into crypto prices?
Oh, it definitely does. Early research already showed links between things like stock market performance, exchange rates, even oil prices, and Bitcoin's value.
Right, exchange rates. How does the value of the dollar or euro affect Bitcoin?
Generally, the research points towards a negative relationship. So if the US dollar strengthens, Bitcoin's price in dollars might tend to dip. Same for the euro, yuan.
Makes intuitive sense.
And here's that complexity again. Some studies actually find positive effects from certain specific currency pair movements on Bitcoin returns, so it's not always straightforward.
And interest rates, like when the Fed raises rates.
Yeah, higher interest rates from the Fed or, say, Chinese interbank rates generally tend to weigh negatively on crypto prices, and they often increase volatility too.
Why is that? Less appetite for risk?
That's the common explanation. Higher rates make safer investments relatively more attractive, potentially pulling money out of speculative assets like crypto, reducing demand. But, again, you'll find the odd study showing a positive link in certain contexts. It's tricky.
What about inflation, the CPI?
Yeah.
Is Bitcoin the inflation hedge, some people claim?
The evidence is really mixed on that one. Some studies suggest a long-term negative link between CPI and Bitcoin price. Others find a short-term positive correlation, hinting at that hedging behavior.
So maybe people buy it short-term when inflation spikes?
Possibly, but then other research finds no significant reaction to CPI news releases at all. So calling it a reliable inflation hedge based purely on the academic consensus, that's a stretch right now.
Okay. What about commodities like gold and oil?
Gold often shows a positive correlation with Bitcoin. They're sometimes seen as similar macro financial assets, maybe alternatives to fiat currency. You hear digital gold all the time. Oil is a bit different. Some evidence points to a negative relationship. One theory is that higher oil prices squeeze budgets, leaving less spare cash for investments like Bitcoin.
In the stock market?
Yeah.
How does the S&P 500 or Dow Jones moving affect crypto?
Generally, there's a positive link found in many studies. Major indices like the Dow, S&P 500, even the Nikkei or Chinese markets. When they go up, Bitcoin often tends to follow, or vice versa.
So they move together sometimes. Or maybe crypto is seen as an alternative when stocks look shaky.
Both theories are out there. It suggests crypto is becoming more integrated into the broader financial system. But true to form, you'll also find studies showing a negative link, or no significant link at all. No single answer fits all situations.
Okay, last economic one. What about just general uncertainty? Economic stress?
That's a really interesting one. There seems to be a fairly consistent negative relationship between various economic uncertainty indices, things tracking policy uncertainty, financial stress, and Bitcoin prices or returns.
So when uncertainty goes UP, Bitcoin price goes.
Also tends to go up, or at least holds its value better than other assets might. This strongly supports the idea that some investors use crypto as a hedge, a safe haven, during turbulent economic times.
Even talk of central bank, digital currencies, CBDCs, that seems to be seen positively.
Yeah, some research suggests the development of CBDCs is viewed as favorable for the digital currency space overall, potentially legitimizing the concept and benefiting existing cryptocurrencies indirectly.
Fascinating. Okay, let's shift to market volatility itself, those wild swings we mentioned. What drives them from within the crypto market?
Right. So systematic risk factors matter a lot. Things like the overall return of the entire crypto market, the size of a specific crypto, its market cap, and its recent price trend or momentum.
Size and momentum together are powerful.
Yeah, studies show that combination can be a strong predictor of returns. There are also other crypto-specific risk factors.
Like what?
Things like max momentum, how close a crypto is to its recent high, reversal factors, tendency to bounce back after a drop, or vice versa, idiosyncratic volatility, its own unique price swings, and liquidity, how easy it is to trade. These all play a role.
And just the general perceived riskiness of Bitcoin or blockchain.
Definitely has a negative impact, yeah. Uncertainty about the system itself or specific risks tied to the blockchain technology used seem to weigh on prices. Blockchain risks specifically can be a strong factor.
What about external shocks, big events?
Oh yeah, they absolutely move the market. Hacks on exchanges, almost always negative for prices.
Makes sense. Confidence hit.
Exactly. Interestingly, some studies found terrorist attacks sometimes led to a short-term positive effect on Bitcoin, maybe risk shifting into alternative assets.
Wow, okay. And COVID-19.
Big impact. Mostly positive for Bitcoin prices, especially early on, but it definitely cranked up the overall volatility across the board. And of course, the stability of the exchanges themselves is a risk factor. Think Mt. Gox back in the day.
Right, that was huge. Okay, let's bring the people back into it. Investors' attributes. Human behavior must play a part.
A massive part. Simple investor attention, how much people are looking at and talking about crypto, shows a positive link with prices. It can even help predict returns and volatility.
So more eyeballs equals higher prices, generally.
Seems that way. Measures of attractiveness or popularity like search volume trends, social media mentions, when those go up, it tends to put upward pressure on Bitcoin prices.
And sentiment, just the general feeling or mood.
Hugely important. Positive sentiment correlates strongly with higher prices. Social media is obviously a key driver and amplifier of that sentiment.
So good vibes push prices up, but maybe also make things choppier, increase volatility.
Exactly. Positive feedback loops can really inflate prices quickly, but also make them unstable. Negative sentiment, conversely, tends to hurt returns and dry up trading volume.
And what about specific influential people, like Elon Musk tweeting?
Oh, definitely. The research confirms that actions and statements, especially on social media by high-profile figures, can have a really significant immediate impact on prices, sometimes even fueling bubble-like behavior.
It's not just celebrities, though, right? Experts, developers?
Correct. The views of recognized crypto experts have been shown to affect Bitcoin returns. Even the expressed emotions of developers working on projects like Bitcoin and Ethereum can correlate with price volatility.
That's really specific. What about negative stuff, like ethical concerns?
Yes, studies have found a negative link. When discussions around unethical practices related to Bitcoin increase, its price tends to suffer. And just the general mood of investors seems tied to market volatility levels.
Which flows right into our last category, social media. It feels inseparable from crypto.
It really is. The evidence is overwhelming that online activity significantly impacts crypto pricing. It's not just sentiment, but information seeking too.
Like Wikipedia views.
Yeah, believe it or not. Studies found that the number of views on Bitcoin's Wikipedia page has a positive and statistically significant effect on its price. It's seen as a proxy for people actively seeking information.
And Google Trends, Google searches. That's the classic one.
Right. Growth in search volume for Bitcoin or other cryptos is often linked to higher returns and is considered a pretty good predictor of price increases. It signals growing interest, potentially leading to more demand.
But isn't there conflicting evidence there too?
There is, yes. You can find studies reporting negative effects where higher search volume actually correlated with price decreases for Bitcoin and Ethereum in certain periods. Again, highlights the complexity.
But overall, the long-term picture for online factors is positive.
Generally, yes. Despite some contradictions, the long-term association between various online activity metrics and crypto prices tends to be positive. More interest, more discussion, more searching often correlates with higher valuations over time.
Wow. Okay, that was definitely a deep dive. So just to quickly wrap up, we've seen supply and demand, the underlying tech, broader economic conditions, the market's own volatility, investor behavior and sentiment, and social media buzz.
Yeah.
all identified in that big review as key factors driving crypto prices.
And it's crucial to remember, like we kept saying, the research is still evolving. You get conflicting findings sometimes. It just reflects how complex and, frankly, how young these markets still are.
Absolutely. But understanding these different pieces, even if they don't always point the same way, seems vital. Whether you're an investor trying to make sense of it all, a policymaker grappling with regulation, or a company even thinking about using crypto.
Totally agree. Which leads to maybe a final thought to leave you with. Given all these interacting forces we've talked about and how new this all still feels, what kind of unexpected event or maybe a future tech breakthrough we haven't even conceived of yet could completely reshape how cryptocurrencies are valued down the road?
That's a big question.
It is. It's a space that just keeps changing, and the factors driving value today might not be the same ones driving it tomorrow. Definitely something to keep thinking about.